You tap buy. A price appears. Done. Under that button, though, buyers are waiting, sellers are waiting, and there are rules for who gets filled first. We'll start simple, then get to how big investors move huge size without crashing the price. A stock trade is just a match. Someone wants to buy, someone wants to sell. Agree on a price and a size, and you've got a trade. Exchanges, dark pools, algorithms, they're all just different ways of finding that match. Those waiting orders live in the order book. Picture two lists. On one side, people willing to buy, ranked by price. On the other, people willing to sell, also ranked by price. The best buyer and best seller sit at the top. The highest price a buyer will pay right now is the best bid. The lowest a seller will take is the best ask. The gap between them is the spread, a small cost for trading right away. Tighter spreads usually mean easier trading. Two common order types. A market order says fill me now at whatever prices are available. Fast. But if there isn't much waiting size, your fill can wander. A limit order says only fill me at this price or better. You might wait, but you pick the worst price you'll accept. In calm stocks, the difference is tiny. When things get chaotic, it matters. Here's the headache for big investors. There's only so much buying interest waiting at each price. Sell a huge amount all at once, and you wipe out the first buyers, then the next, and your average price gets worse as you go. That's how a giant dump can push the stock down against the seller. Your order doesn't always go to one public exchange. Sometimes it's a public venue where quotes are visible. Sometimes a private matching room, a dark pool. Sometimes a broker matches it off the public book. Different paths. Same job. Get filled at a price you can live with. A dark pool is a private place where a large buyer and a large seller can meet without showing their full size on the public list first. That can keep other traders from reacting early. You're not guaranteed a better price. You're looking for a quieter match. Skip the jargon for a second. Say you have to sell 10 million shares. You don't have to do it in one giant click. You can break that into hundreds of smaller sells over hours or days. Watch the big box turn into small ones. That's the idea. Smaller pieces are less likely to smash through the waiting buyers all at once. Two approaches. Dump everything quickly. Price falls hard under you. Or drip smaller pieces through the day. Price drifts less. Pros use software to decide how fast to drip, sometimes based on how busy the market is, sometimes just by the clock. You don't need the acronyms. Slow drip usually hurts less than a panic dump. How do they keep score? Take the price when you decided to sell and compare it to the average you actually got. Same 10 million shares. The dump might average much worse. The slow drip might stay closer to your starting idea. That gap is real money. At home, you feel the same thing as slippage when a market order feels worse than you hoped. Sometimes dripping is too slow. Then two big sides may negotiate a one-shot deal, often with a small discount or premium for speed. Later, the public tape may suddenly show millions of shares trading. It can look like a shock. Often the conversation already happened. Near the close, volume often spikes. Many big funds are judged on the official closing price, so they trade then on purpose. A late rip or fade is not always a new rumor. Sometimes it is simply closing time traffic. 3 real stress tests. Flash crash. What it looks like when the waiting buyers disappear. Archegos. What happens when giant forced sells hit too fast? GameStop. What happens when routing, crowding, and volatility feed each other? Same ideas as before, just under pressure. May 6, 2010. Within minutes, major U.S. indexes plunged and then snapped back. Algorithms kept trading hard while human liquidity stepped away. Left side, the waiting buyers thin out. Right side, price gaps down. then rebounds. That's market impact with almost nobody left to catch the sell. March 2021. Archegos capital blew up. Banks rushed to unwind huge concentrated positions. Names like Viacom and Discovery got slammed. This wasn't a quiet drip over days. It was urgent, forced selling, dumping size, and sometimes blocks under pressure. Walking the book and one-shot deals happening in public at scale. January 2021. GameStop turned into a crowded fight between short sellers and retail buyers. Prices and volume went vertical. Brokers, exchanges, and off-exchange venues all mattered because the flow was fragmented and positioning was extreme. In a squeeze, where orders go and what gets constrained can amplify the chaos on the chart. Flash crash, empty book impact. Archegos, forced size. GameStop, venues, and crowding. Hold those three in your head, and a lot of scary headlines start making more sense. Quick checklist. Sudden giant print? Maybe a negotiated deal. Not a secret tip. Huge volume, but price barely moves? Maybe two big sides swapping. Last minute spike? Maybe closing traffic. When markets are jumpy, prefer limit orders. And don't build a whole theory from one strange print. Once you see the book, the spread, and how big orders get broken into pieces, weird tape prints look a lot less mysterious. Prefer limit orders when markets are jumpy. Be careful near the close, and don't rewrite a whole story from one print. Subscribe to Tickertales, not financial advice.